Exiting a startup isn't just about selling a company, it's about selling it at the right time, to the right buyer, and for the highest possible value. Whether through an IPO, an acquisition, a secondary sale, or even a management buyout, the goal remains the same: maximizing returns for investors, founders, and employees while ensuring the company's long-term success. But getting to a successful exit isn't as simple as waiting for an offer to come along. A startup's final valuation is shaped by a combination of financial performance, strategic positioning, and market timing. Even the best companies can end up exiting under the wrong conditions, missing opportunities and settling for lower valuations than they might have achieved otherwise. The most successful exits happen when a startup isn't just valuable but indispensable, positioned in a way that makes it a must-have for acquirers or the public markets. For investors, planning an exit isn't something that happens overnight. It's a process that begins years in advance, shaping how the company grows, how it competes, and how it tells its story to the market. For venture investors, timing an exit is about maximizing returns while balancing market conditions, competitive dynamics, and fund cycles. Move too early, and a company might not reach its full potential. Wait too long, and shifting market conditions could erode value. The best VCs work proactively with founders to identify the optimal window for liquidity. Industry cycles play a significant role. Venture investors track market trends to determine when investor appetite for IPOs or acquisitions is at its peak. The SaaS boom of 2020 to 2021, for example, saw record-breaking valuations. Companies that exited during this period locked in premium returns, while those that held out faced declining multiples as markets cooled. Competitive pressures also shape exit timing. If major players in a sector are aggressively acquiring, VCs may push for an exit to capitalize on premium valuations before market saturation sets in. Conversely, if a portfolio company is still gaining dominance, delaying an exit could allow for a significantly higher valuation later. One of the biggest factors is the VC fund lifecycle itself. Most funds operate on a 10-year cycle, and as the end approaches, LPs expect liquidity. If a company's lead investors are nearing the end of their deployment window, they may encourage an exit, even if the company isn't at its peak, to lock in returns and distribute capital back to LPs. Ultimately, the best exits happen when a startup is positioned as a high-growth, high-value opportunity. Strong financials, market momentum, and favorable external conditions create the ideal exit scenario. A well-timed exit isn't just about securing a good deal, it's about ensuring that both founders and investors maximize the value created over years of strategic growth. For venture investors, a high-value exit isn't just about securing liquidity, it's about ensuring that a portfolio company commands the strongest possible valuation. Whether through acquisition or IPO, the most successful exits happen when a startup is not just another player in its industry, but a must-have asset for acquirers or public investors. The most valuable exits tend to occur when a startup meets several key criteria that make it especially attractive to acquirers and investors. First, the company must be highly differentiated and difficult to replicate. Startups that have built a defensible moat, whether through proprietary technology, strong network effects, or brand dominance, stand out in the market. These qualities make them significantly more appealing to potential buyers who are looking for unique and sustainable competitive advantages. Second, the startup should be scalable and grounded in strong financial fundamentals. Businesses with high margins, high customer retention, and a track record of efficient growth are more likely to secure premium valuations. These financial indicators signal that the company can continue to expand while maintaining profitability. Finally, the startup must represent a strategic fit for acquirers or institutional investors. Companies that solve a critical problem for major industry players or align with broader investment themes are well-positioned to attract competitive bids. Strategic relevance can be just as important as performance when it comes to exit outcomes. When all of these factors align, the likelihood of a high-value exit increases substantially. Positioning a startup for a high-value exit requires years of strategic planning. A strong, differentiated brand signals leadership in a space, which makes a company a prime acquisition target. Adobe's $20 billion acquisition of Figma wasn't just about technology, It was about acquiring the undisputed leader in collaborative design tools. Financial fundamentals are just as critical. VCs work closely with portfolio companies to optimize revenue growth, gross margins, and customer retention. High LTV/CAC ratios and scalable revenue models are key indicators that a startup isn't just growing fast, it's doing so in a sustainable, capital-efficient way. From an acquisition standpoint, the most valuable deals happen when a startup fills a strategic gap for a larger company. Microsoft's $26 billion acquisition of LinkedIn wasn't just about social networking. It was about integrating LinkedIn's professional data and tools into Microsoft's enterprise software ecosystem, creating long-term synergies. For companies eyeing an IPO, preparation starts long before the public listing. VCs play an active role in helping startups build relationships with institutional investors, secure analyst coverage, and establish governance structures that appeal to public markets. The goal isn't just to go public, it's to ensure a successful offering that maximizes investor demand and long-term valuation. Expanding into new markets or forming key partnerships can also significantly increase exit value. When Spotify went public, its valuation wasn't solely based on streaming revenue. It was driven by global expansion and strategic agreements with record labels that proved its long-term industry positioning. Ultimately, the best exits don't happen by chance. They are the result of careful, investor-led strategy that ensures a startup becomes an essential, high-value asset in its industry. Even a well-timed, well-positioned startup still needs careful execution in the final stretch of an exit to maximize value. The process of preparing for a sale, IPO, or secondary transaction involves fine-tuning financials, strengthening governance, and creating a compelling narrative that makes the company irresistible to buyers or investors. Financial and operational performance needs to be flawless. Clean financial statements, solid unit economics, and efficient operations all help command higher valuation multiples. When it comes to negotiations, having multiple buyers or investors at the table creates competition, driving up value. Companies that control the narrative and negotiate from a position of strength get better terms and higher valuations. Market timing also remains a key factor in the final execution. Going public or selling in the middle of a downturn can be a costly mistake, while launching an IPO in a hot market can mean dramatically higher returns. A great startup exit doesn't happen by chance, it's engineered. The best founders and investors start planning their exit strategy years in advance. They position their company as an industry leader, build competitive advantages, and align themselves with acquirers or public markets long before the exit happens. Timing is everything for venture-backed startups. Market cycles fluctuate, investor sentiment shifts, and strategic buyers' priorities evolve. The difference between a good exit and a great one often depends on the VC's ability to guide startups toward the optimal exit window. The most experienced investors don't just help build valuable companies, they leverage their market insights, industry relationships, and pattern recognition to ensure their portfolio companies exit at the precise moment when they can command the highest possible valuation.